Circle Internet Financial is a global financial technology firm. It stands at the forefront of digital currency innovation. The company is best known as the principal operator of USD Coin, or USDC. USDC is a type of digital money known as a stablecoin. This means its value is designed to stay stable, unlike other cryptocurrencies like Bitcoin that can see wild price swings. Specifically, USDC aims to maintain a one-to-one peg with the US dollar. For every USDC token in circulation, Circle holds an equivalent amount of US dollars or short-term US government bonds in reserve. This backing is intended to give users confidence that they can always redeem their USDC for traditional dollars. Stablecoins like USDC play a crucial role in the digital asset ecosystem. They act as a bridge between traditional finance and the burgeoning world of cryptocurrencies. Traders use them to move in and out of more volatile assets without having to convert back to fiat currency through a bank. This provides speed and efficiency. Stablecoins also facilitate payments and remittances, potentially offering lower costs and faster settlement times compared to traditional systems. In decentralized finance or DeFi applications, stablecoins are fundamental. They are used for lending, borrowing, and earning yield, forming the bedrock of many innovative financial products. The stability they offer makes digital transactions more predictable and accessible. The importance of USDC and stablecoins in general cannot be overstated in the current digital economy. They provide a reliable medium of exchange within the often turbulent crypto markets. Imagine trying to buy a coffee with a currency whose value could drop by 10% before your transaction even clears. Stablecoins aim to solve this problem. They offer a sense of security and predictability that is essential for broader adoption of digital assets. As more businesses and individuals explore blockchain technology, the demand for trustworthy and transparent stablecoins like USDC is expected to grow. Circle, through USDC, has positioned itself as a key player in this evolving financial landscape. Circle's mission extends beyond just issuing USDC. The company aims to build a new global economic infrastructure powered by digital currencies. This involves creating tools and platforms that make it easier for businesses to use stablecoins for payments, treasury operations, and other financial services. By focusing on transparency and regulatory compliance, Circle seeks to build trust and encourage mainstream adoption of its offerings. The success of USDC is central to this vision, serving as the foundation upon which these broader ambitions are built. Its stability and reliability are paramount to attracting users and partners to its ecosystem. Circle's primary method for generating revenue is quite straightforward yet powerful. It stems directly from the reserves it holds to back every USDC token in circulation. When users purchase USDC, they give Circle traditional US dollars. Circle doesn't just let this money sit idly in a vault or a non-interest-bearing bank account. Instead, it invests these reserve assets predominantly in short-term US Treasury bonds and cash deposits held at regulated financial institutions. These investments earn interest. This interest, earned on the vast pool of customer funds held in reserve, forms the lion's share of Circle's income. It's a model somewhat similar to how banks can earn interest on customer deposits. This concept is often referred to as reserve yield. Let's break it down with a simple example. Imagine Circle has 100 billion USDC in circulation. This means it holds approximately $100 billion in reserve assets. If these assets generate an average annual yield of, say, 3%, then Circle would earn $3 billion in interest revenue from these reserves over the course of a year. The actual yield fluctuates with prevailing interest rates set by central banks like the Federal Reserve. When interest rates are high, Circle earns more. When they are low, its interest income naturally decreases. This direct link to macroeconomic conditions is a key characteristic of its revenue model. The beauty of this model from Circle's perspective is its scalability. As more people use USDC and the total supply grows, the amount of reserve assets also increases. Consequently, even with the same interest rate, the total interest income rises. This creates a strong incentive for Circle to promote the adoption and use of USDC. The larger the USDC market capitalization, the larger the potential revenue from reserve interest. This dynamic has fueled Circle's efforts to expand USDC's presence across various blockchains and integrate it into numerous financial applications. The company regularly publishes attestation reports on its reserves, aiming to provide transparency and assure users about the backing of USDC. It's important to understand that while Circle earns interest on these reserves, the USDC holders themselves generally do not directly receive this interest. The stablecoin is designed to maintain its peg to the dollar, not to be an interest-bearing instrument for its holders in the same way a savings account might be. The yield generated is Circle's revenue for managing the stablecoin, ensuring its operational integrity, maintaining regulatory compliance, and investing in the growth of its platform. This distinction is crucial. Users benefit from the stability and utility of USDC, while Circle profits from managing the underlying assets that provide that stability. While interest income from USDC reserves is undoubtedly Circle's financial powerhouse, the company is not solely reliant on this single stream. It has been actively developing and promoting other services aimed at diversifying its revenue sources, although these currently contribute a much smaller fraction to its overall earnings. One significant area of focus is its suite of platform services. These services are designed for businesses, developers, and financial institutions, offering tools to integrate digital currencies and blockchain technology into their operations. This includes APIs for minting and redeeming USDC, managing digital asset wallets, and facilitating payments. Circle also offers transaction and treasury services. These are tailored for businesses looking to leverage stablecoins for cross-border payments, risk management, and optimizing their treasury functions. For example, a company might use Circle's platform to convert traditional currency into USDC, send it across the globe quickly and cheaply, and then have the recipient convert it back into their local currency. Circle may charge fees for these types of transactions, or for providing specialized treasury management solutions. This is an area with significant growth potential, as more businesses recognize the efficiencies offered by blockchain-based payment rails and digital dollar solutions. Furthermore, Circle is investing in building out what it calls the Circle Mint, and a programmable wallet platform. Circle Mint is designed to provide qualified businesses with direct access to mint and redeem USDC, offering a more streamlined process for large volume transactions. The programmable wallet platform aims to give developers the tools to embed digital currency wallets directly into their applications, making it easier for end users to interact with stablecoins and other digital assets. While these initiatives are still in relatively early stages compared to the established reserve interest model, they represent Circle's strategic push to create a comprehensive ecosystem around USDC and digital currencies. Despite these efforts, it's crucial to reiterate that as of early 2025, the revenue generated from these ancillary services pales in comparison to the income derived from its USDC reserves. The company's financial reports and public statements consistently highlight reserve interest as the dominant contributor to its top line. The success of these other ventures will depend on widespread adoption by businesses and developers, a competitive market landscape, and Circle's ability to offer compelling value propositions. For now, they represent future growth avenues rather than current primary profit centers, showing a clear ambition to build a multifaceted financial technology company. Circle's recent financial performance tells a story of impressive top-line growth, largely fueled by the expansion of USDC and favorable interest rate environments. As the circulation of USDC increased, so did the pool of reserves generating interest income. In periods where central banks raised interest rates to combat inflation, the yield on Circle's reserve assets, predominantly short-term US Treasuries, also climbed. This combination has led to significant jumps in Circle's reported revenue figures. For instance, if USDC circulation grew from 50 billion to 70 billion, and average yields on reserves moved from 1% to 4%, the impact on revenue would be substantial, showcasing the leverage in their model. However, this revenue growth has been accompanied by a concerning trend shrinking profit margins. While more money has been coming in, the costs of doing business have also risen sharply. A significant factor contributing to these increased costs is Circle's revenue-sharing agreement with Coinbase, a major cryptocurrency exchange and a co-founder of the Center Consortium, which initially launched USDC. Under this agreement, Circle shares a portion of the interest income generated from USDC reserves with Coinbase, particularly from USDC distributed and held on Coinbase's platform. As Coinbase's role in USDC distribution and holding grew, so did the share of revenue flowing to them. Operating expenses have also played a part in squeezing profits. These include costs associated with regulatory compliance, technological development, security infrastructure, marketing, and global expansion efforts. Running a compliant and secure stablecoin operation at scale is an expensive endeavor. As Circle strives to maintain its position in a competitive market and prepares for potential future regulatory frameworks, investments in these areas are non-negotiable. The company has also been investing in new products and services, which incur development and marketing costs before they begin to generate significant revenue, further impacting short-term profitability. The dynamic illustrates a common challenge for rapidly growing technology companies, balancing aggressive expansion and market share acquisition with sustainable profitability. While strong revenue growth is a positive indicator of USDC's adoption and the effectiveness of Circle's core business model, the pressure on profit margins highlights the competitive and cost-intensive nature of the stablecoin market. Investors and analysts closely watch not just the revenue figures but also the company's ability to manage costs and negotiate favorable terms with partners to ensure long-term financial health. The Coinbase revenue share, in particular, has been a focal point in discussions about Circle's profitability. The stablecoin market is far from a monopoly, it's actually a fiercely competitive arena. Circle's USDC, while definitely a major player, faces constant pressure from established giants like Tether, USDT, and a growing number of new entrants, including those launched by traditional financial institutions or other crypto-native companies. This intense competition creates what is often described as a race to the bottom in terms of fees and revenue retention for stablecoin issuers. Competitors are continually looking for ways to attract users and platforms, and this often involves offering more favorable economic terms, which can directly impact an issuer's profitability. This race to the bottom manifests in several ways. For instance, platforms that integrate stablecoins, like exchanges or DeFi protocols, may demand a larger share of the interest revenue generated from the stablecoins held or transacted on their platforms. To secure prime placement or deeper integration, stablecoin issuers like Circle might have to agree to less favorable revenue-sharing arrangements. This is evident in the significant portion of USDC interest income shared with partners like Coinbase. If a competitor offers a platform a better deal, Circle could risk losing market share or facing demands for similar concessions from other partners. Furthermore, the direct competition for end users also puts pressure on margins. While Circle doesn't directly charge users for holding or making basic transactions with USDC, the overall value proposition really matters. If other stablecoins offer perceived advantages, whether in terms of accessibility, integration with popular apps, or even indirect benefits through platform partnerships, USDC could lose ground. This forces Circle to continuously invest in technology, security, and marketing to maintain its appeal, all of which add to operating costs. The need to remain competitive limits Circle's ability to unilaterally increase any potential fees or retain a larger portion of its reserve interest. Ultimately, this competitive pressure means that Circle's profit margins are constantly under threat. Even if the total USDC supply grows and interest rates remain favorable, the portion of that revenue Circle gets to keep could shrink if it has to concede more to partners or spend more to acquire and retain users. This is honestly a critical challenge. Circle must innovate and demonstrate clear value to justify its position and maintain healthy margins. The company's focus on regulatory compliance and transparency is one way it seeks to differentiate itself. But the economic realities of a competitive market remain a powerful force shaping its financial outcomes. Despite the pressures, several significant opportunities could fuel Circle's future growth and profitability. The most straightforward driver is the continued adoption and expansion of USDC itself. As more individuals, businesses, and institutions recognize the benefits of using a regulated dollar-pegged stablecoin for payments, remittances, trading, and treasury management, the circulation of USDC is likely to increase. This directly translates to larger reserves and consequently higher potential interest income, assuming interest rates remain at reasonable levels. Growth in key sectors like decentralized finance, Web3 gaming, and institutional digital asset trading could all contribute to greater USDC demand. The overall growth of the stablecoin market represents another major tailwind. The total market capitalization of stablecoins has seen explosive growth over the past few years, and many analysts predict this trend will continue as digital currencies become more mainstream. Even if USDC only maintains its current market share, a larger overall pie means a larger slice for Circle. If Circle can capture an even greater percentage of this expanding market through strategic partnerships, technological innovation, and a strong regulatory posture, the growth potential is amplified. The global demand for digital dollars is immense, especially in regions with unstable local currencies or inefficient payment systems. Prevailing interest rate environments also play a crucial role. Periods of higher interest rates like those seen in 2023 and 2024 are highly beneficial for Circle's primary revenue stream. When central banks keep benchmark rates elevated, the yield on Circle's reserve assets, which are mostly short-term government securities, increases, boosting its interest income significantly without any change in USDC circulation. While Circle cannot control macroeconomic policy, a sustained period of moderately high interest rates would be a strong positive factor for its financial performance. This makes monetary policy trends a key variable to watch for anyone assessing Circle's prospects. Finally, the development of clear and supportive regulatory frameworks for stablecoins could unlock further growth. Regulatory uncertainty has been a lingering concern for the digital asset industry. However, robust and sensible regulations could provide greater legitimacy, attract more conservative institutional capital, and open up new use cases for stablecoins like USDC. Circle has consistently advocated for clear rules and has positioned itself as a compliance-focused entity. If regulations emerge that favor transparent, fully reserved stablecoins, USDC could be a prime beneficiary, potentially leading to increased adoption and new partnership opportunities with traditional financial institutions. While opportunities abound, Circle also navigates a landscape fraught with significant risks that could challenge its growth trajectory and profitability. One of the most prominent risks is the potential for declining interest rates. Circle's revenue model is highly sensitive to interest rate fluctuations. If central banks, particularly the US Federal Reserve, were to significantly lower benchmark rates, the yield on Circle's reserve assets would decrease. This would directly reduce Circle's interest income, even if the circulation of USDC remained stable or continued to grow. A prolonged period of near-zero interest rates, as experienced in the past, would severely impact its primary revenue source. Intensifying competition remains a persistent threat. As discussed, the stablecoin market is crowded with Tether's USDT holding a dominant market share and new, well-funded competitors emerging. These competitors might offer more aggressive revenue-sharing deals to platforms, develop innovative features that attract users, or achieve broader integration across key ecosystems. There's also the risk of so-called decentralized stablecoins gaining more traction, which operate on different models that might not involve a central issuer like Circle. Losing market share to these competitors would directly impact Circle's reserve base and therefore, its revenue potential. Over-reliance on a single primary income stream, interest on reserves, is another structural risk. While Circle is developing other services, these currently contribute minimally to its overall revenue. If the core revenue from reserve interest faces sustained pressure, whether from low interest rates or increased revenue sharing, the lack of significant alternative income sources could become a major vulnerability. Diversifying its revenue base is a strategic imperative for Circle, but, successfully scaling new business lines like payment processing or software services in competitive markets takes time and significant investment with no guarantee of success. Regulatory uncertainty, while also an opportunity if resolved favorably, poses a substantial risk if new rules are restrictive or overly burdensome. Governments and regulatory bodies worldwide are still formulating their approaches to stablecoins. Unfavorable regulations could impose high compliance costs, limit the types of assets Circle can hold in reserve, restrict certain use cases for USDC, or even favor bank-issued stablecoins over those from non-bank entities like Circle. Navigating this evolving regulatory landscape requires significant resources and adaptability, and an adverse outcome could materially impact Circle's operations and financial prospects. The future path of stablecoin regulation is perhaps one of the biggest unknowns. To better understand Circle's financial dynamics, let's consider a simplified, hypothetical scenario. Imagine in year 1, USDC has an average circulation of $40 billion. If the average yield Circle earns on its reserves is 1.5%, its gross interest revenue would be $600 million. 40 billion times 0.015. Now let's say its operating costs, plus revenue share obligations amount to $200 million. This would leave Circle with a net profit of $400 million. This example illustrates the basic mechanics of their primary revenue model and how costs affect the bottom line. Now, fast forward to year 2. Suppose USDC circulation grows significantly to $60 billion due to wider adoption. Simultaneously, average interest rates rise, allowing Circle to earn an average yield of 4% on its reserves. The gross interest revenue would then jump to $2.4 billion, 60 billion times 0.04. This demonstrates the powerful combined effect of growing circulation and rising interest rates. However, let's also assume that due to increased competition and the need to secure key partnerships, Circle's revenue share obligations have increased, and operating costs for expansion and compliance have also risen, totaling $1.2 billion. In this scenario, the net profit would be $1.2 billion. Revenue quadrupled, but costs also sextupled. Here's a simple table to visualize this hypothetical trend. Average USDC circulation, 40 billion to 60 billion, up 50%. Average reserve yield, 1.5% to 4%, up 167%. Gross interest revenue, 600 million to 2.4 billion, up 300%. Cost and revenue share, 200 million to 1.2 billion, up 500%. Net profit, 400 million to 1.2 billion, up 200%. Profit margin drops from about 66.7% to 50%. A decrease of 16.7 percentage points. This simplified example highlights key trends often discussed in relation to their financials. Revenue can grow dramatically with USDC adoption and favorable rates. However, if costs and revenue sharing grow at an even faster pace, profit margins can compress, as shown by the profit margin decreasing despite a tripling of net profit. This illustrates the profitless prosperity concern if cost pressures are not managed. The actual figures are, of course, more complex, but this shows how the interplay of circulation, interest rates, and cost structures dictates Circle's financial health. Understanding these levers is crucial. A scenario where USDC circulation grows but interest rates fall would paint a different picture. For instance, if in year 2 the yield was only 1% instead of 4%, gross revenue would only be $600 million, potentially leading to a loss if costs remained at $1.2 billion. This sensitivity underscores the importance of all contributing factors, not just the headline growth in USDC usage. Transparency in reporting these components helps analysts and the public gauge the true financial performance and sustainability of Circle's model. Looking ahead, several key indicators will be crucial in assessing Circle's ability to maintain its winning streak in the competitive stablecoin race. Firstly, USDC's market share and its absolute growth in circulation will remain paramount. A consistently growing USDC supply, preferably outpacing the overall stablecoin market growth, would signal strong demand and adoption. This is the foundational layer upon which Circle's primary revenue model is built. Tracking the total value of USDC in circulation, and its share relative to competitors like USDT and new emerging stablecoins, will provide a clear gauge of its market position. Secondly, Circle's ability to manage its revenue retention and profit margins will be critically important. This involves closely watching the terms of its partnership agreements, especially with major distribution channels like Coinbase. Any significant changes in revenue-sharing arrangements or the proportion of interest income Circle retains will directly impact its bottom line. Furthermore, diligent management of operating expenses, covering technology, compliance, security, and marketing, without stifling innovation or growth, will be essential. The trend in profit margins, not just absolute profit, will indicate how effectively Circle is navigating competitive and cost pressures. The success and growth rate of Circle's non-reserve interest revenue streams will be another vital indicator. As the company invests in platform services, payment solutions like its new cross-border payments API, and tools for developers, the market will look for tangible evidence of traction and revenue generation from these initiatives. Meaningful diversification of revenue would reduce Circle's dependency on the potentially volatile interest rate environment and strengthen its overall financial resilience. The contribution of these newer ventures to total revenue will be a key metric of strategic success in building a more multifaceted financial technology company. Finally, the evolving regulatory landscape and Circle's positioning within it will undoubtedly shape its future. Achieving greater regulatory clarity, particularly in major jurisdictions like the United States and Europe, could be a significant catalyst. Circle's ability to comply with new regulations efficiently and leverage its compliance-focused approach as a competitive advantage will be crucial. Conversely, unfavorable or overly costly regulatory developments could pose substantial headwinds. Therefore, tracking regulatory pronouncements and Circle's strategic responses will be essential for understanding its long-term prospects in the dynamic world of digital finance. These factors in concert will paint the picture of Circle's future.